Let's begin. My name is Michael Dow. I'm talking about macro and markets today. There's lots to talk about, so we'll jump right in. Thank you for joining us. If you need any help navigating the webinar functionalities, here's a quick helpful chart. There's a speaker view in the upper right-hand corner that might be helpful. We're going to do a Q&A at the conclusion of the presentation, but you can submit a question at any time. To submit a question, open the Q&A box and just type in your question. I'll take a look at it and we can answer it towards the end of the presentation. So, where do we stand? The first thing we want to be able to determine in an environment like this is what is the damage to the economy. The containment measures have caused unprecedented losses in both output and in employment. So those mitigation efforts, while absolutely necessary, are causing a difficult time for those of us whose livelihoods depend on forecasting for a living. The first thing we need to do and try to understand is to find the bend in the curve. The new cases needs to decline. It needs to decline for a period of time, and it needs to be durable. The next thing we can do once we've contained the virus is to add up the economic damage done during the containment and mitigation efforts. Finally, the government has been incredibly proactive. We need to add up the government's mitigation efforts and net them against the economic damage to see what's happening. All the while, it's important for us to understand what the credit conditions are. That is, the bond market is incredibly important for the functioning of not just the economy, but the stock market. If we can see a healthier bond market, a bond market that's not subject to dislocations, we will see a reduction in equity market volatility. Both of those two things will improve the ability for business managers, for workers, for CFOs and CEOs to make business decisions. A reduction in uncertainty related to credit conditions and a reduction in the uncertainty that is caused by equity market volatility is a precondition for a stabilizing of the US economy and a continued improvement in the US equity market. So we've seen quite a bit of that. It's been a rather historic first sell-off and then return to a bull market. We've never seen anything like it. Talking about the virus first, update on both global and US cases. These are logarithmic scales. On the left is global cases, on the right is US cases. The very good news is that there seems to be some, at least, slowing in the growth, which is what the log factor tells you. That's, again, the most important thing for us, not just from an investment standpoint, but quite clearly from a humanitarian standpoint. Got to get this thing under control. In terms of different states, we got New York on the left, most cases, and also the steepest bend. So things are going well now after a really rough period in New York. California, not as much. Texas, which is reopening, not so much. And Illinois, where I live, again, just not as much of a bend in the curve. Who is opening? If you're a green state here, you have a partial reopening or you're going to be opening soon. The yellow states remain shut down or heavily restricted. As a result, it's a bit of a, as you would expect in a federalist government structure like we have, it's up to the governors and to the big city mayors to determine how quickly and where the reopenings are happening. So it's gonna be piecemeal. It's going to be slow. It's going to be staggered. It's not going to be all at one time, and that's for the best. In fact, the key to a successful reopening is making sure that we're balancing two very important features. One, the healthcare concerns, that is lives, versus the downside of having an economy that's near complete shutdown, which is livelihoods. So lives versus livelihoods is what we're talking about, and the constraining factor, or the factor that will limit any continual reopenings, has to be the capacity of the local healthcare critical care facility. If you've got an ICU bed at the local hospital, you can continue available, and a ventilator, you can continue to reopen. So that will be the constraint as we move from this period of hurting that we've been in to a period of healing, both in terms of the virus and the economy. So we had a sudden stop in the global economy. A sudden stop is usually associated with a balance of payments crisis in an emerging market, but we've seen an entire global sudden stop. This is the Global Purchasing Managers Index. Global manufacturing, way below the expansion contraction line on the top chart. That's the blue. In terms of the green line, that's global services. Global services have had it even worse, as you might expect. You can manufacture a widget potentially with some social distancing, but you can't get a haircut unless you're in the same room. So services down much more so. We'll see that in some high frequency data in a second. In terms of a couple of countries, I've highlighted the US activity and China's activity in terms of the Purchasing Managers Index below. This is just a great high frequency activity indicator. It comes out monthly. It gives you a much better sense of the current environment than GDP, which is often reported with a significant lag. Again, anything over 50 is good. China, which had obviously the first experience with both the virus and the containment measures and then reopening, has now recovered pretty well. Whereas here in the U.S., we're still seeing really unprecedentedly bad economic data, and it won't stop. Tomorrow, we're going to get an unemployment number, which shows non-farm payrolls down 20 to 22 million. It's something we just can't even imagine. Not just the pure magnitude of the numbers, but the humanitarian concerns and the public welfare associated with such employment losses is just inconceivable. Unprecedented losses. Haven't seen this before ever. Here we are back in the U.S. The sudden stop in economic activity in the U.S. is going to cause us to, and this is our estimate, to see a quarter-on-quarter annualized GDP number of something on the order of minus 27% in the second quarter, after a reported minus 4.4, 4.8% in the first quarter, which is going to be revised much lower. We see a recovery. This is, by the way, just to put this in context, on the left chart is GDP going all the way back to 1948. So there's been no quarter-on-quarter GDP figure that we've ever seen that even approached the minus 27 we're likely to see when it starts, when it's reported in July of 2020. On the right is the unemployment rate. The unemployment rate back in the Great Depression got to 22 or so percent. The data I have here from the Federal Reserve Bank of St. Louis only goes back to 1948. As a result, this will, at 20%, which is, I think, the number that's likely to be reported tomorrow, or 16% likely tomorrow, but it'll peak at 20% in the following months. It appears that this will be by far and away the worst labor market we've ever seen since the Great Depression. Looking at some more high frequency economic activity. This is a restaurant bookings data from OpenTable on the left, and on the right is airport activity. This is the TSA throughput, so number of travelers in thousands. On the left, you can just see this is a percentage of restaurant bookings that changed from the prior year. Anything, you can't get lower than minus 100. Obviously, no one's going to restaurants. Thankfully, carryout is still available, but no one is going to restaurants. But there has been an uptick in the last week or so in that data, but it's just a very, almost statistically insignificant number. It's coming from Texas, Oklahoma, Georgia, et cetera, some of the states that are reopening. In terms of airport activity, again, as a percentage of the prior year's throughput at the TSA, we got down to minus basically 95%. So we were 95% below the same week in 2019, back in sort of the first couple of weeks of April. There is an uptick here too, so that's a hopeful sign. We're down minus 94% from the same week. This is the second week of May now, so this is up to date as of yesterday. This data, I think, is really helpful when trying to understand whether or not we're actually seeing a return to economic activity. I'd like to make the point that differentiating between actually reopening a state and having the economy recover is there's a wide gap between those two things, and the gap is determined by consumer behavior and consumer attitudes towards whether or not you're safe. I think even if the governor of Illinois said it's time to go back to the restaurants, not everyone would immediately. And while I'm very much looking forward to getting on an airplane again, I'm probably in the minority. What's the Fed been doing? This is important. We just talked about the massive amount of output losses and labor market distress, but the Fed has not been sitting on their hands. They immediately cut rates to zero. This is the federal funds rate here, going from 2 3/8 down to the midpoint of an eighth of a point. So effectively, we're at the zero lower bound, or the effective lower bound. ELB is what the Fed officials call it now. So we're at the effective lower bound, but that doesn't limit the Fed's ability to create the conditions for additional liquidity. Once you cut rates to zero, then you have to start doing QE again, which is also known as balance sheet expansion. You can do repo operations to provide liquidity to certain markets. You can provide forward guidance. That's when Jay Powell says we're going to keep rates lower for longer and do everything that we can to support the bond market. And you can create any number of different credit lending facilities, commercial paper funding, primary dealer funding, money market lending, Main Street business lending plan, the term asset-backed securities lending fund, the secondary market fund, the primary dealer market fund. It's just a litany of alphabet soup that the Fed has brought to bear. And they are and will continue to be prepared to use the full range of tools they need to support the flow of credit here in the United States. How are they doing that? Well, they're expanding their balance sheet. This is the Federal Reserve's balance sheet going back from 2010 until the first quarter of 2018. The point here is the blue is, of course, the increase in the Federal Reserve's assets. The orange line is the S&P 500. So I would say it's not too difficult to draw a conclusion that the larger the size of the Fed's balance sheet, frankly, the larger the liquidity provision available to go into something. And in many cases, that something turned out to be the stock market. So as long as the Fed's increasing the size of their balance sheet and doing quantitative easing, that is supportive, as it is intended to be, to the US stock market. Here's where we are today. This is from the first quarter of 2018 to the present. The Fed tried. They tried as hard as they could to reduce the size of the balance sheet. It got down to 3.8 trillion in September of 2019, but then we had the repo market issues, and they had to reopen the liquidity spigots to fix the a short-term funding market that's essential to banking services. And subsequent to that, of course, we had the containment measures and lockdown. As soon as on March 15th, the Federal Reserve took interest rates to zero, and then immediately thereafter, they began buying primarily Treasury and mortgage-backed securities. In addition, this huge jump, it's almost a doubling in the size of the balance sheet. We're not done yet. We're going to 9 trillion sometime in the near future. By the way, that would be 40% of US GDP, which is an absolutely stunning figure. It's unprecedented. We weren't even that, the Fed didn't have that big a balance sheet even after World War II. Fiscal, it's not just the Fed that's doing their part. The federal government has come loaded to bear with substantial fiscal stimulus. Phase 1 was March 6th. It was 8.3 billion. We got phase 2 2 weeks later. It was 100 billion. We got the CARES Act on March 25th, 2.2 trillion, and that ain't all. Phase 3.5 came on April 23rd. That was a PPP top-up plan, the lending to small businesses for payroll protection. Ran out of money almost instantaneously, and the Congress and the president thankfully immediately got together, and after a little bit of wrangling in the first 2 weeks of April, did a top-up bill of 350 billion, which has I think been very well received. The money's not getting out to everyone as quickly as it needs to be. You saw I suggested the unemployment number is going to be very large, so it's mitigating it, but it's not obviously going to completely eliminate the difficulties in the labor market. Today we got another initial jobless claims number of over 3 million, which takes the 7-week job losses to 33 million people, 2.2 trillion in CARES Act. 33 million people have lost their jobs in the last 7 weeks. Again, unprecedented destruction in the labor market. We need another one. We're going to get phase 4. It's probably going to be about $1 trillion. Should be focused on state and local governments. State and local needs, state and locals, the states say they need $500 billion. The local governments say they need $500 billion. That equals $1 trillion. It's going to be subject to some political constraints. That is, there are some folks that want to do a state and local bill, and there are some folks that do not, which is different than the CARES Act. Everyone could get behind payroll protection and lending to small businesses. But as it relates to the states, it may not be as easy, but it's going to happen. It's been an unprecedented fiscal policy response, and it would be a shame to undo it because you let the state and local governments, who are on the front lines of education, healthcare, law enforcement, et cetera, if you don't support those folks, you will undo much of the good that was done with the other stimulus packages. So I anticipate that ultimately will happen. It will just not be a linear process to get there. what does all this stimulus mean? If we do get we've had 3 trillion to date, this is nominal GDP in the US, by the way. Back in 2000, nominal GDP in dollars was 13 trillion. We're now at 19 trillion. So if you take 19 trillion divided by 4, you get about 5 trillion a quarter in GDP. If you add 3 trillion in stimulus, that's 60%, 62% of one quarter's GDP. If you get to 4 trillion, it's very substantial. I'm trying to highlight here just how much money is being spent to support businesses and workers, and I think it's astonishing. It is absolutely unprecedented, and I think it should be noted. Is it enough? We don't know yet. We'll know once we can fully contain the virus and start adding up the total economic damage and see where we're headed. I can be highly confident in suggesting, though, that the government, both the Federal Reserve and the federal government, will remain vigilant and focused on providing support in coming quarters, but it's fiscal policy now where we will really see some traction. Monetary policy has done what they can. They're not letting their foot off the gas pedal at the Fed, but it's fiscal policy that's going to get us through it now. What does it all mean? Well, if you're writing checks for $4 trillion, the money has to come somewhere. And it's going to come in the form of first, a larger budget deficit in 2020. Fiscal year 2020, Phil Swagel, the director of the CBO, put a blog out the other day that suggested that 17.9% in terms of a budget deficit will be the largest since World War II, when we were at minus 27% budget deficit. If you keep adding up the budget deficits, that increases the overall government debt, and government debt as a percentage of GDP is about 106%. That's both federal government debt and state and local. Based on Phil's projections at the CBOE, it looks like we're headed towards something on the order of 143%, which, to put that into context, Greece was at 150% when they started to have their troubles in 2011. Italy is also at 140%. Only Japan, at 250% of debt to GDP, would be substantially higher than where the U.S. would shake out. Not good. In fact, typically bigger fiscal deficits have generally led to higher long-term interest rates. That is a relationship that has broken down since the Great Financial Crisis. It's broken down for a variety of reasons, not least of which quantitative easing by the Fed and other factors that have kept a lid on long-term interest rates. But at some point, it seems likely that all of this budget deficit and frankly, the issuance of US Treasury supply, more supply equals lower prices equals higher yield. So if US Treasury needs to issue another 4 trillion in debt, which it has, it's already issued 1.3 trillion since March. We're going to see in about a week and a half one of the biggest auctions in the history of the US Treasury. They're issuing debt right and left, yet interest rates have not risen to meet the extraordinary new supply. It's a bit of a conundrum, but I think I can explain it, and I'll talk about that in a second. Let me just summarize what our major economic forecasts suggest. Real GDP is going to bottom at minus 27%. Unbelievable number. I mean, this is the scale we used to deal with, -3 to +4%. And now we're at minus 27 for GDP. Headline inflation could go to 0. Not expecting deflation. We're in a disinflationary environment, which means lower but positive inflation, probably not going to deflation, but it wouldn't surprise me if we did. By the way, our outlook for the economy is actually a little bit less hopeful than the outlook in the consensus. The consensus says there's a V-shaped recovery. We think it's more of a U. A U-shaped recovery would also be consistent with this type of an inflationary environment. Unemployment rate, again, peaking at 20%, but then declining. A lot of the folks that are out of work right now, hopefully will get right back to work without too much difficulty. The longer they stay out of work, the bigger the hit to economic growth and productivity, because you have to retrain. Some of those folks will leave the workforce. So sooner is better, which, by the way, there isn't a better summary of why the Fed and the federal government are doing what they're doing. If you can make this a V, or at least a shallower U, and avoid an L-shaped recovery, just to take the letter scheme to the extreme, you're actually investing a substantial amount. The money that's spent to do that can be viewed as an investment in the labor force, which is an investment in productivity and reaps benefits in the long run. The Fed is just absolutely pinned at the effective lower bound for the foreseeable future. There's just no scope for the Fed to go negative. They don't want to go negative. The Federal Reserve officials that I speak to do not want to go negative. I don't blame them. We could both in terms of the Fed funds rate and in terms of U.S. Treasury yields, if the economic environment dictates, but they don't want to go there. So they'll do what they can with the balance sheet, with forward guidance, and with other tools. And they have a huge toolkit and a money printing press, and frankly, unlimited paper and ink. So the Fed's not running out of bullets just because they're at the effective zero bound, but they will be at 0% interest rates for the foreseeable future. So we talked a little bit about how this is the fastest bear market and the fastest bull market in history. This is the S&P 500 level going back to the fourth quarter of 2018. And I highlight a couple of movements here. First, in the first quarter of 2020, of course, in the red bars, we were down 34% peak to trough. So we had a peak on February 24th, 25th-ish at 33.86 plus or minus. And then we fell all the way to 21 and change. And that was a 34% drop. Since that time, the Federal Reserve has done what they've done. The market has priced in a fair amount of fiscal stimulus. And frankly, in the most recent couple of trading sessions, today included, there's a lot of hope about the potential for treatments like remdesivir out of Gilead, pharmaceuticals, and other, and a vaccine potentially development, perhaps quicker than ever before developed. That would be great. It will put most of all of this constant COVID-19 in the rearview mirror when and if we get not if, but when we get a vaccine. In the meantime, the stock market has rallied spectacularly. Again, highlighting the fact that you don't want to fight the Fed. You want to let the government, they understand what the problem is. You knew they were going to come to the rescue. Whether it was going to be this swift a recovery, no one could have known. But the S&P has done something spectacular here that you wouldn't have expected. We're up 24% from the lows back in Christmas Eve of 2018. I would be willing to bet if I had said in the first quarter of 2020 that sometime in May we would be talking about a 20% unemployment rate and a minus 30% GDP figure and 33 million people filing for unemployment claims, and the stock market's only down 10 or 11% year to date. If I think you would have sold that. You would have sold that all day long. That is to say, you would not have accepted that as possible. But yet here we are, down 11% today, and maybe a little less after the close. Why are we down so little? Well, one of the answers is because I want to make sure we give credit where credit is due. You needed, and the Fed knew this, the Fed needed to fix the bond market. And the Fed knew how to fix the bond market because they did it in 2008 and 2009. They had a playbook. It wasn't even that dusty. They pulled it off the shelf and they did it. They took rates to zero. They expanded the balance sheet and they opened up all sorts of alphabet soup worth of credit facilities that we've discussed. So these are investment grade corporate bond spreads. Investment grade corporate bond spreads, the wider they are, the more dislocated and the less functioning the market is. So I've inverted them to correspond to the decline in the S&P 500. So this is the S&P 500. These are credit spreads. S&P declines in value. Credit spreads go wider. Again, this is an inverted scale. Then you see credit spreads recovering and the equity market following right along. So you have tighter spreads, a better functioning bond market, and that has provided substantial support to the equity market. It really owes a lot to the Fed and to the recovery in the bond market. The equity market is what everybody talks about at cocktail parties, but the bond market is the engine that causes the plumbing, the financial plumbing of corporate America to work properly. And if you gum up the plumbing of the credit provision mechanism, or you shut down the bond market, the equity market would immediately follow. So the Fed fixed the bond market, and that fixed the equity market. There's going to be some industry winners and losers. This is not a complete list. It's a tentative list. It's not something I think that is terribly controversial. Things that are winning in the current environment all have to do with technology or pharmaceuticals. So the ability to deliver things to people, the ability to improve people's welfare in terms of the drug provision and healthcare, entertainment that's streamed as opposed to going to a cinema. And frankly, Amazon's been a lifesaver for many of us in terms of getting groceries and other things delivered. So e-commerce these are all the winners. The losers, those are also uncontroversial. It's everything we're not doing right now, or was part of the headline when we first started to hear about COVID-19. So cruise lines, tourism, airlines, trains, oil and gas was a surprising one. That's just a function of the fact that without any economic activity, oil prices were going to decline, even without the Saudi Arabia, Russia oil supply spat that occurred back in March, which disrupted not just the market for oil globally, but was a potential very, very difficult hit to US oil and gas producers, particularly those that were BBB rated. So oil and gas, it's going to have a shakeout. Good balance sheets are going to survive. Bad balance sheets aren't. Last but not least, of course, traditional retail. There's just no scope for traditional retail, frankly, to compete with e-commerce. Some of these trends were already in train prior to COVID-19, and they're accelerating now, but it's important to note. Commercial office space, maybe not everybody gets to work at home, but a lot of people like it, and they probably will. I can't wait to see a hockey game. I was all set to go see the Chicago Blackhawks 24 hours before the governor shut down the state and before they canceled the NHL season. And cinemas, we're not going to the movies anymore. We will, and that'll all happen, but not until we get a vaccine. And even subsequent to that, people are going to find that they kind of like staying at home. So I think that'll likely persist. What does all of this mean for S&P 500 earnings? I say it's just a big guess. You could put a number on it and see where we're trading. This is $135 EPS. That means we're trading today at a little higher than 21.1 times. This was as of last night's close at 28.48 on the S&P. And this is just a fan chart showing if you keep the 135 constant and trading at different PE, what level do we get to? So at 21 times, if we actually go back to more normalized PE, we're down 600 points, 700 points now on the S&P. So it doesn't give me a great degree of confidence. It's not great to think about the S&P 500 trading where it is at $135 worth of four-quarter earnings. So the equity market's not. In fact, it appears that the equity market's looking forward and through it to 2021 earnings of something on the order of flat to 2019. I'm not so sure we get all the way back to 2019 EPS in 2021, but if we did, we're trading at a much more reasonable and respectable 17.5 times. Still not cheap compared to longer term PE ratios, but it seems clear to me the S&P 500 is absolutely looking through the current environment. By the way, not just looking through it, but trying to guess. Most of the companies, by the way, that are reporting for first quarter have done so. We're at 400 plus companies now, and it's pretty bad. It's going to be much worse in the second quarter. But the point is, most companies, a lot of big bellwether companies, don't have enough visibility on the next 2 quarters even to provide earnings guidance. So if the companies aren't going to report earnings guidance, it's very difficult for investors to think about what the fundamental value of the equity market is. So we've said that the equity market is trading in many respects more on sentiment than it is on fundamentals, because we just don't have a handle on what the fundamental value of 4-quarter EPS is. So it's looking through. The market is clearly looking through to 2021. And that, again, is not a strong foundation. It may work out perfectly well. That would be great, but it's more of a hope than right now than a realization. We'll see in coming quarters that we'll get a better idea. So why is the stock market trading at the current level? Because the economy is reopening and we're seeing good news on containing the virus. And don't leave out the fact that the Federal Reserve and the federal government have done everything they possibly could and will continue to do more to provide stimulus to remove the fat tails. That is, the economy is reopening, it's limiting the economic damage, And that should lead to a recovery in corporate profits sooner rather than later. Progress on containing the virus, if as long as the reopening is, if we can keep the virus contained and reduce the hotspots, which is a function of testing, contact tracing, and treatments, then the reopening will appear more durable. In fact, the economy reopening and progress on the virus are symbiotic. Those things are interlinked and can't be separated. All of this has led to some confidence in the market. Why? Again, just to put a cap on it, the Fed rescued the bond market. The stimulus is replacing lost income, and they've taken the worst case scenarios or the tail risk out. Let me talk a little bit about the bond market. This is a long-term US Treasury 10-year yield history. This 10-year Treasury yields go back to 1790 when they first started issuing Treasury bonds. The average for 229 years, by the way, is almost 5%. The peak was back in the great inflation that came in the 1980s, early 1980s. It cost you 16% or 15% for a mortgage. Short rates in the US were at 21%. Long-term or 10-year Treasury yields peaked at 14%. And then we had this great decline in interest rates as monetary policy became more credible. The monetary academics identified money printing as a problem, and we stopped doing it. So basically, it was the rise of the central bank and the rise of the central bankers that caused this decline in interest rates. Well, let's fast forward to past the great financial crisis. This is second quarter of 2016. We were normalizing the balance sheet. Interest rates were rising. We got to almost 3% back in September of 2019, or 2018, excuse me, right before the economic slowdown and the crash of the stock market, or the decline in the stock market, almost to a bear market in the fourth quarter, as the market began to price in more difficult economic circumstances because the stock market was down so much. Interest rates declined, and then they stabilized again right up until February, when then they fell off, literally fell off a cliff. We actually had 10-year Treasury yields yielding less than 40 basis points. So 40 basis points, somebody bought a 10-year Treasury bond back in March that's going to guarantee them 40 basis points of risk-free yield for the next 10 years. You can buy one right now for 70 basis points, less than 1% for 10 years, risk-free yields. So there was a tremendous amount of stress and strain, and in fact, the market was pricing in almost a depression. In fact, I can't imagine what economic scenario corresponds to a 38 basis point 10-year yield. But that was fixed pretty quickly by the Federal Reserve, and frankly, the CARES Act, which again reduced the worst case scenario. I like looking at longer term history. I think understanding history is one good way to understanding putting into context what we're seeing in the present. But make no mistake, this is the long-term history for 10-year Treasury yields. And on this scale, we're here. So haven't been there before. Once again, uncharted territory makes forecasting very difficult. The market actually, and I'm going to skip over this chart real quick just to suggest, these are forward yield curves, by the way. Forward Treasury curve here, this is the 10-year Treasury curve. In 2023, this chart's telling you that the 10-year Treasury is going to trade at 121. So 3 years from now, only up 50 basis points. It's going to take 10 years for the US Treasury yield, the 10-year yield, to get back to 2%. So no one's pricing in negative interest rates. They are possible if economic developments in the US warrant it, but the current market pricing and the forward interest rate market suggests that we're going to be lower for longer. Negative interest rates, possible. Necessary, maybe, if we're in a depression, but we're not there yet. Here's an interesting chart. I'm just going to throw it in here and talk to it really quickly. The average cost to trade a US Treasury 10-year note is about 0.06%, or 230 seconds is how as 10-year Treasury yields trade. That's the average. This is the 10-year Treasury yield Bidask spread. That is the price between what a dealer would pay and what a dealer would sell you a 10-year Treasury yield for. It's just an indicator of transaction costs. The wider the bid-ask spread, the more dislocated markets are. The cost to trade, that's right, a 10-year Treasury was $1. It cost you $1 to trade $100 worth of Treasury bonds back on March 19th. That's unheard. That is a broken market. This is the most liquid, most tradable market in the world. This sign to me suggested, well, the Fed needs to do more work. And of course they did. They opened up all of those funding facilities. And you could see here that transaction costs in the liquid, most tradable market in the world declined, but they're still slightly elevated back in April. As of today, they actually had a little bump towards the end of April, but now we're getting back to normal. Again, this is all due to the Fed, all credit to the Fed. Here's credit spreads. Again, another way to tell if bond markets are working or if they're not working. You get triple B rated investment grade corporate bond spreads on the left, going all the way back, including the great financial crisis. So the interesting thing here I want to point out, we didn't get nearly as high in spreads as we did back in 2008, 2009. So that's, the Fed did what they did in 2008 and 2009, but it took them 3 to 4 months to do it. Whereas they did what they did in 3 to 4 months 12 years ago, they did it in 3 weeks. The point is, it's an absolute astonishing recovery here in investment grade corporate bonds and in high yield corporate bonds. Again, all credit to the Fed. Due to swift Fed action. Now, municipal bond markets. The recovery actually is likely to depend on your credit rating. That is, here are municipal bond yields today and municipal bond yields for non-investment grade, by the way, in the green, and investment grade municipal bonds in the blue. Non-investment grade municipal bonds back in 2008, 2009 were yielding 11%. They got to 6% here in the most recent environment. Note that the investment grade municipal bond market has recovered, but the non-investment grade municipal bond market hasn't yet. And that is a function of the fact that there still hasn't been as much support given to state and local municipalities. And frankly, there's been some unhelpful rhetoric about whether or not a state can declare bankruptcy. That doesn't soothe bond investors' feelings, which is what we're trying to accomplish so we can support the economy. And high yield bonds then have not recovered as a result, whereas investment grade municipal bonds have. Federal support is needed. It's going to be subject to some political negotiation, but I think we're going to get it. It would be difficult to understand why the government wouldn't support, the federal government wouldn't support state and local while at the same time supporting corporations. State and local governments are pretty big employers. And so by supporting state and local government, you're supporting workers, and they should do so. What's all this mean? Well, it should mean inflation, but it's not on the radar screen. These are inflation measures on the left, and then market forward-looking inflation measures on the right. US PCE core is what the Federal Reserve focuses on. They have a 2% target. We're at 1.7%. We've been at 1.7 or below 2% since 2010, except for a couple of very brief periods. As long as inflation is below the Fed's target, they can continue to shovel money into the marketplace. So inflation's not on the Fed's radar screen because US personal consumption expenditures, the core measure, is way down below their target. The overall measure, which includes food and energy, by the way, is much lower because of energy prices, of course. And as a result, the Fed's got a lot of scope and a lot of latitude for adding liquidity. It's not a problem. The Fed, the bond market's telling you that inflation for the next 5 years, which is US 5-year forward break-even inflation, is only going to be 72 basis points. And if I had graphed the 10-year figure for break-even inflation, it would be 1.1%. So there's no inflation either realized or inflation on the horizon right now. It's not something that we need to be concerned about. The Fed's not concerned about it. The government's not concerned about it because we're in a TINA environment. There is no alternative. The Fed needs to do what the Fed's doing, and the government needs to do what the government's doing. So they will continue to do so until and if inflation rears its ugly head. Something we're keeping an eye on. You have to, because ultimately macroeconomic theory dictates that it will be a problem, and monetary economic and academic theory suggest it. But it's not something we need to worry about for the next 4 quarters at least. So why are rates so low? Because of the Federal Reserve, because potential GDP is expected to be lower, and frankly, because we have the reserve currency status. That means our assets here in the US are much more demanded than assets in either the Bank of Japan, the Swiss National Bank, or even the Euro. Why? Because commodities trade in the US dollar. We have the best and strongest institutions. We have an independent central bank. We are the reserve currency. And we are using that. We have many, many more tools that we can bring to bear. I call them degrees of freedom, both in terms of monetary and fiscal policy because of our reserve currency status. So really, there's just, with low interest rates and continuously low interest rates, because there's demand for US dollar denominated assets and foreign demand, we can continue, they will continue to fund our budget deficit, and they will continue to keep interest rates low, which will allow the US to continue to service its debt at a manageable level. If interest rates do rise in the future, and it's something I'm keeping a close eye on, it's likely we would enter a period of financial repression. And financial repression is not a bad thing. It's what happened post-World War II, because the debt to GDP ratio was, again, about as high as it is now, or what we're expecting in coming quarters and coming years. Financial repression is just a way to deal with a large debt load. Capital asset prices, that is stock prices, bond prices, they can do okay in a period of financial repression. So it's not, it shouldn't be viewed as anything nefarious. It's just what the government can and will do to manage the debt load. What are we thinking about in terms of going forward consumer and household and corporate changes related to COVID-19? Well, I'll give you the conclusion right off the bat. Everything that's happened is likely to produce a slower growth path going forward. We're going to see higher household savings rates. We're going to see less vacations. We're going to see less revenue in restaurants because there's going to be more space, and definitely going to see higher health insurance premiums. What does it hold for the corporate sector? Less business travel, more paid leave, that's higher labor costs, offset by lower T&E. A lot of folks are going to work from home. And frankly, the big one, at least for the next couple of quarters, if you're taking any money from the government, fewer stock buybacks. Stock buybacks and dividend payments accounted for one heck of a lot of the return in the stock market over the last 10 years, particularly buybacks in the last 3 or 4 years. You can make a strong case that the equity market would not have performed quite like it did without stock buybacks. That's a factor we're keeping a close eye on. In terms of the government sector, you're going to get more health and safety regulations. We're going to have our own stockpiles of medical supplies here in the United States. And frankly, we're going to issue more government bonds. So if we can get some reduced concerns about reopening, that will be dictated by consumer behavior. And frankly, consumer behavior will dictate the timeline for our economic recovery. If the behavior doesn't change dramatically, which I find hard to imagine, then we can get reopened quicker. That's why we think at Beacon Point, it's likely to be a U-shaped recovery. Okay, what's the game plan? Frankly, we've got this sentiment swinging around between the S&P 500, interest rates, commodities. It's a result of things that we should anticipate. That is, they're likely to be an echo, whether it's of the virus and hotspots that pop up around the US, either because we reopen too quickly, or for sure, because we will have another flu season starting next November, and the virus will return. So we should continue to see sentiment swings that affect asset prices. The one thing I'm really concerned about is, while we do have a lot of support for corporations here in the United States, they came into 2020 with weaker balance sheets, and we've seen in the last 10 or 15 years. The last 10 years have been, you've seen a lot of debt issuance. A lot of that debt issuance actually went to pay for stock buybacks. So you increase debt, reduce your equity, increasing your debt to equity ratios by definition. And as a result, it's weaker balance sheets indicate that any kind of stress on cash flows, like no business is built for zero revenues. So we should expect to see certainly higher downgrades, but the government will do what they can to support and replace the income loss that can be used for debt service for corporate America, because this isn't their fault. So higher than expected corporate defaults are likely to come down the pike, but we've had historically very low defaults, less than 2% in high yield, much less than 1% in investment grade for the last 10 years on average. So it's not a big leap to suggest we're going to get higher than expected corporate defaults. Certainly, though, there's a couple of trade-offs here, like the lower than expected corporate profits. If the top line is lower, that's great, but lower labor costs at least have one, I wouldn't call it a silver lining, because it means more people are out of work, but lower labor costs do have a tendency to improve margins. So lower than expected corporate profits because of lower top line revenue, but it's possible that that may not be realized because of some of the adjustments that we've talked about. So finally, I just want to talk about some of the longer term implications of the stimulus response, and then I'll try to get to some questions. What are the longer term implications? Well, frankly, the changes we just discussed in consumer and corporate behavior, absolutely, positively, no question, higher deficits and debt. That is today. That's not a future expectation. What is an expectation, or is something we should be keeping our eye on, is the higher deficits and debt could lead to higher inflation. Almost invariably, it will lead to higher taxes as we try to balance the budget. And all of those things, higher inflation and higher taxes, invariably, say the theory, equal lower growth rates. So again, lower growth rates are an issue. It's something that we're going to have to deal with, but it's not a given, and neither are lower corporate profits in the near term. It's just a function of the fact that we are doing everything that needs to be done. The government doesn't have any other choice. We're going to have higher deficits and debt, and we just have to move forward. What does it mean? It means that we should be looking at buying what the government is buying. And this is a game plan for portfolios now. And again, what I'm saying here is very general in nature, and you should absolutely contact your consultant or your financial advisor for more specific recommendations. But broadly speaking, it seems to make sense to buy what the government is buying or buy what the government is supporting. Government is supporting the U.S. bond market, U.S. credit and U.S. municipal bonds, particularly investment grade, but the Fed can purchase through the lending program U.S. Credit that's non-investment grade as well, just not non-investment grade munis yet. They will if they have to. Focus on industry and asset class winners. Just for simplicity, I'm saying that's summarized by large cap growth. Provide liquidity, that's through less liquid private investments. That seems, if the world is starved of liquidity and bond markets are breaking down and bid-ask spreads are getting wider and spreads on corporate credit and municipal bonds are wider, you are going to get paid to provide liquidity by putting money in less liquid private investments. You're going to get paid to do that. So these are the things that we've been talking about with many of our clients. Focus on the U.S. bond market, in equities, U.S. large cap growth, and less liquid private investments. We believe actually this is a temporary shock, but we just don't know. We don't know how deep it will be or how long it will last. So you've got to remain cautious until we get a vaccine, really. But sooner rather than later, the number of cases will plateau, and then we can start to tote up the economic damage and measure it against what the federal government's doing. And now with that, I'll stop and see if there's any questions in the Q&A that might be of interest to the broader market, to the broader audience. Bond markets, did bond market price drop? Okay. So I talked a lot about bond markets, so I think I addressed that. How most likely will the U.S. increase taxes in the future to offset the increase in debt? All taxes are going up. There's just no, the numbers we're talking about here are extraordinary. And the way that taxes work versus economic growth is, if you need to balance a budget, and what we used to say in sovereign credit is when you needed to do a structural reform and balance your budget, there's two ways to balance a budget, which is what we need to do now. One is either raise taxes or reduce expenses. Nobody likes to have their expenses reduced, and no politicians get elected by providing fewer services. So almost invariably, you get higher taxes as opposed to reduced expenditure. Unfortunately, the literature on this is very clear. Higher taxes almost invariably lead to lower growth, which kind of works at cross purposes to your desire to reform the budget and collapse the deficit. So someone is asking about the national debt. Are we looking at austerity? No, the federal government, I don't think so. I think higher taxes, look to cut expenditures from the budget where you can, but probably not. More likely, we'll enter a period of financial repression. And what that means is that the Federal Reserve will control longer-term interest rates to make sure debt service is manageable. They can do that by buying bonds or asking the banking system to continue to buy US Treasury securities. At the same time, you're going to want to increase inflation to a certain extent, not a lot, but a little. And over time, over a 20 to 30-year period, just like we saw post-World War II, the real debt burden gets paid down. I want to use an example to bring this financial repression argument home, because I think it's very important. If you issue debt today at par and inflation is 3% a year over the course of the next 20 years, and GDP is as 100, GDP is going to be closer to 200 because of compound, and not even including compounding. And as a result, you now have $200 worth of GDP to pay back the debt you issued at 100 today. So inflation is good for for paying down debt, and it's a main feature of financial repression, and we're likely to see that. Is there a point where the Fed balance sheet just won't work? The answer is yes, but the market will tell us that before the Fed does. That is, when inflation rises, when the debasement of the currency by issuing so much of it becomes a problem, you'll see it in the inflation statistics. But right now, again, the Federal Reserve is the owner of the printing press of the reserve currency. And as a result, the exorbitant privilege that we derive from being the reserve currency is likely to persist. It'll persist until something else comes to take our place. And I don't see another candidate for reserve currency on the near-term horizon. Ultimately, the country with the largest economic growth rate and the largest economy, and frankly, the strongest navy that can patrol trading routes and keep the trade routes open and trades in your currency, that's the reserve currency. So big country, strong military, and a move to having global commodity trading denominated in your currency are the things to look for. It's how we became the reserve currency during the interwar period from World War I to World War II, and then solidified our position at Bretton Woods in 1945 when all the governments of the world got together and decided the U.S. was the reserve currency. So that it's not likely that we're going to lose that status anytime soon. Tax revenue dropped precipitously due to job losses. Where did trillions of dollars of stimulus come from? Bonds, issuing bonds, increased debt. You borrow your way out of a problem like this, which seems ironic, but there you have it. If I was in 100% cash today at a 80-20, how would you recommend getting back into this market? I wouldn't. I wouldn't have gone to 100% cash, to be perfectly frank. And that's a question for your advisor and for your consultant. If government programs will be cut in order to find money, which ones? Can't answer that question. Not many. Probably not the non-discretionary. I mean, you have Social Security, Health and HHM, and Defense, and some of those, are politically doable, and some aren't. So I wouldn't. It's more likely we enter a period of financial repression than we see substantial austerity. Today's data, it's almost sure Q2 is even going to be worse. Shall we reallocate our investments? No. Into more conservative funds? Probably not. I mean, if I'm telling you what I think second quarter is, you can rest assured that the market's already got it priced in. And as a result, by reallocating, the horse is out of the barn. So my view is the stock market is pricing in a V-shaped recovery. So from that perspective, I always compare the economic data to what the current valuations are, and I would suggest that it's gonna be kind of rocky. If the S&P was back at 2,300, I'd say I'd have a lot more an easier time suggesting what could be done, because you could see that there was going to be a lot of stimulus being poured onto the U.S. economy. But with the stock market closer to 2,900, which is only 10% below where we were at 3,300, a record high, and with all of the things that have happened, as I suggested, 33 million people out of work, equity markets seem priced relatively hopefully. Seems like the S&P is at the level it was last year. Yes. Do you think this is a top? Can't say with any degree of certainty. Like a good economist, if I'm asked to give a point estimate, I don't want to give a time estimate. If I'm going to give a time estimate, I don't want to put a point on it. But I would say this, since it is my job to forecast things, that we're not at the top forever. I feel very strongly, and maybe I'll close on this, that the U.S. economy is a going concern. It's the most vibrant, dynamic, highly educated and motivated labor force and research and development engine that the world has ever known. And as a result, we will get through this. We'll come out on the other side. We're going to beat the virus. We're going to get a vaccine. And things are going to be a little more clear. But right now, we're still in a world of considerable uncertainty because we're dealing with a biological enemy that we don't fully understand. It didn't exist until 6 months ago. And as a result, it's very hard to make any kind of predictions with any kind of conviction. So what I would say is hang tight. Know that your advisors and your consultants are looking at the macro environment as diligently as we possibly can. We're trying to make judgments and trying to give you the best advice we can in an uncertain environment. Many times that means hang tough, sit tight, reallocate, rebalance to your longer term strategic allocations. That's advice we've given clients, the clients that can act upon it over the course of the last couple of months, and we'll continue to do so. We'll continue to be there. We're working hard. Your advisors and your consultants are available for additional consultation. If I didn't get to your question here on the live on the webinar, I'd be happy to, I'll look through them and I'll be happy to get back to many of you with answers as soon as I possibly can. And in the meantime, thank you very much for joining our quarterly macro and markets call. I look forward to seeing or speaking to all of you again sometime the first week of August of 2020. Thanks for joining.